Personal finance now, thanks to our partners Forsyth Barr. Spring is the season. September, historically, a weaker month, though, on the markets. Mark Richardson, investment advisor, is with us. Mark, good morning.
Yeah, morning, mate.
Why?
I don't know. Well, no, I sort of do.
Great, we'll leave it there. See you later.
First of all, this is a tendency, not a rule. But September over the ages has generally been the weakest time on the market. Now, there's tax and fiscal reasons for it, and it is basically centralised in the US, and then of course that market seems to drive every other market, so it has a knock-on effect. But the end of the fiscal year in America, 30th September, so a lot of these large US mutual funds might sell their losing positions and realise those losses, and they can write those losses off against their gains. They have a slightly different tax system over there, so that's selling will often create a weaker market. And it's also as simple as the fact that Americans are coming back from their summer holiday in the Hamptons, and they've got to pay for it. So they have to start actually selling a little bit of the share portfolio. So there is selling pressure in September, which you have to be a little bit aware of. But yeah, I guess I don't know whether it's useless information or not, because I'll say it time and time again, every time I come in here, you can't time the market, it's time in the market. But there are months that you need to be a little bit aware of.
So what are the months? Apart from shitty September.
Well, there is this saying, sell in May and go away. So May, June, July can be all right, August and September. So basically go away to about November. October can be a little bit volatile. Now, the reason October is volatile is historically, a lot of the major share market crashes have happened in October. So you had the 1909 bank panic, when they were trying to manipulate share price and everyone lost faith in the banking system and they all tried to get their money out at once. You had the Great Depression started in October 1929, 87. The big share market crash of 87, and then 2008, the GFC. It all kicked off in October. But then October is often quite a good month because people are buying on the back of weakness from September. And then you have the run-in through November, through our summer. The American winter, of course, holiday season can often be quite good.
Interesting. We've been watching, obviously, the job numbers come out of the States, and then the market pricing in potentially 3 rate cuts from the Fed by Christmas.
Yeah.
And that's seen markets respond quite positively because they're like, oh, we're going to get a rate cut, things are going to get better.
Well, if the cost of money comes down, then you often get a bit more reinvestment, and that can be great for the economy. What you have to remember with the rate cuts is they generally affect the short end of the curve. And what puts, I guess when it comes to personal consumption and your ability to spend and feeling a bit more well off, it's when you refix your mortgage. Now, a lot of those mortgage rates and loan rates are tied to the far end of the curve, so the curve will steepen. It doesn't really affect those so much. So, it can be two bob each way to a certain extent.
Yeah, right. Okay, what does all of this mean? So we've been through the seasons, geez, all of them. We've been through the ages from 1909.
Yeah.
What is the takeaway for investors?
Just to be aware of it, to be accepting of the volatility that might come with it, knowing that it'll bounce back. For us, it might be a time to just actually manage a little bit of risk. Maybe if you've had one stock that's been very, very good, you might go, well, let's just take a little bit of that off the top, protect some of the performance, wait for an opportunity to, once the market might have come off, if it's reverted to tendency, let's say, and then you might get back on and hope, that if the tendencies play out, that you bought low and you've had an opportunity to get into the market at a lower level, and away you go again. But as I say again, these are tendencies, not rules.
Yeah.
It's about just get in the market and spend time in the market.
And do it with someone trusted, preferably. Hey, good to see you, Mark. See, you did know. You're lying. You did know what you were talking about. Mark Richardson, personal finance here on Herald Now, investment advisor with Forsyth Barr, and we talk personal finance every week thanks to our partners Forsyth Barr.